Hi, everyone. This is Tim from DigitalOcean. Excited to have you back. If you've attended one of our previous webinars or presentations or live coding sessions, that's part of this series of small business focused presentations. If not, if you're new, welcome. We're really excited to have you. We have a super exciting guest and panelist with us today, Brandon Carroll. And before I get into Brandon and Leighton and what they do and what we're going to talk about today, just a couple administrative items. If you're using YouTube on a desktop, there's a chat panel on the right-hand side. Feel free to use it to ask questions as Brandon is going through his presentation. If it's relevant, we'll answer it live. If it's something that we feel like we want to address at the end of the presentation, we'll do a Q&A at the end of the presentation. But we encourage you to ask questions around the presentation, really tap into Brandon's expertise. If you're on a mobile device, it might be at the bottom below the video. This is being recorded, so you'll have access to this after the fact, and Brandon is committed to making sure that you have access to the slides as well. So don't worry about getting access to the slides or the recording. All of that will be saved and available to you following the presentation. So with that, I'm going to let Brandon start, but real quickly, just as a means of introduction, Brandon works for a company called Leighton, which is a financial consulting firm that has over 18,000 clients. They're present in 11 countries. They specialize in a variety of different things, but today's focus is on R&D tax credits. And Brandon himself has over 15 years of experience, specifically in the software space. So we think he brings a lot of value to the DigitalOcean startup community and all of the DigitalOcean customers as well. So with that, Brandon, we're super excited. So I'll let you take over and flesh out your introduction and then get started on your presentation.
Awesome. Thanks so much, Tim. Appreciate the intro and welcome everyone. It's awesome to have you here. Thanks for tuning in, and hopefully this can be a good education learning experience to take a little deeper dive into what research and development tax credits are, how they apply to startups and companies of all sizes. And my hope is really to shed some light on how you can really feel some additional financial relief from these things and hopefully accelerate some of the company's growth. So as Tim said, my name's Brandon. I'm a senior R&D consultant over at Leighton. And yeah, we partnered up with Hatch by DigitalOcean because that's a natural fit. We work with a lot of software companies of all different shapes and sizes. And as you'll see in this presentation, we're going to walk you through a bunch of things, but software is inherently a qualified activity, the development of software for an R&D tax credit. So that's really why we're here today, and that's what I'll try to focus on, but keep an overarching, presentation of how all companies can leverage this exciting credit. So without further ado, I'll just run through what we're going to cover. I'm going to talk about the credit, what it is, how you might be eligible, how we define it. How does the IRS define R&D? What types of activities qualify for software companies and other things, and then also how do you calculate it? How do I claim it? What can be claimed, and then, like Tim said, we'll finish off with some Q&A at the end to cover anything maybe that I might have overlooked, and always speak up if I'm on a slide that you really want me to dive a little deeper on something, or if you had a specific question, we'll try to do that in real time just so that we can have some good interaction throughout this whole presentation. So without further ado, we'll cruise on to what is the R&D tax credit. So the R&D tax credit is a incentive for companies that are developing a product or a service. And basically what this allows you to do is reduce the amount of income tax that you have and other forms of tax. And so this was an incentive put in place for companies that are improving or developing a new product or process used by their business. The credit's been around since the 80s. However, in 2015, as a part of the PATH Act, they made it permanent. And this was to really stimulate the economy, to drive new job growth, and to really make the U.S. a little more competitive on a global scale. It's for companies doing new technologies, creating new techniques, processes, things like that. And so you might, when you think R&D or research and development, you might think someone in a lab coat or biotech companies, but the definition is actually quite broad. And with the onset of new technologies every day, and even non-tech companies using pieces of technology or having a piece of software that's connected to their business, there's more that qualify today than most would think of. And so let's get into some of the different categories. It's pretty broad. Software and technology will be my focus for today, but obviously manufacturing, engineering, sciences, energy, all these types of industries listed, a lot of times there's software involved with them as well. It's really kind of an interesting topic for research and development, because software seems to touch every business these days in some way. Even if they're developing hardware, there's software attached to it. So this is just a little overview of different types of companies that qualify. And so here's how it works. This is how, in the eyes of the IRS, this is how they measure and qualify activities within a business. They use something called the 4-part test. So first and foremost, you have to be making something that's a new or improved product, process, technique, formula, or software. That's part number one. Part number two is that it has to be technological in nature. So something of a hard science, and for software, that would be computer science. And three, there has to be a process of experimentation where you're trying different things and alternatives are evaluated and tested. And building on that, there has to be an elimination of uncertainty. So that's really expanding on that process of experimentation and vetting other solutions out there on the market and making sure that yours is providing some competitive advantage. So that's really the 4-part test. Now for software companies, or even companies that don't make software, a lot of times, sometimes they'll develop software within the company that might not be for the customer, for their customers, but for internal use. Whether it's to speed up their internal processes, whether it's getting analytics and insights on, maybe how they operated as a company or how their software or products are being used. And so software developed for internal use can also be qualified, but there's an additional 3-part test that's built on top of that 4-part test. And it's just, it's a little more scrutiny on the software internally. It's got to be innovative. It has to be intended to be, unique or novel and really differ in a way. There also has to be a significant economic risk that the company or the taxpayer is committing to for any type of substantial development. And then it also has to be, it can't be commercially available on the market, So this would be anything that, like I said, that the company has developed internally that to help them, work through internal decisions and different things like that. So for software companies, here are some areas of R&D and types of activities that would qualify. Anytime, platform development. SaaS companies typically all have a platform, whether it's web-based or it's a web app or however it's delivered. Platform development is inherently a part of R&D. Any types of analytics built into software, that kind of ties into development of algorithms. As Tim mentioned before, I've worked for a plethora of different software companies. Mostly we're based in media technology and audio technology. Algorithms and digital signal processing was something that I stood by a lot with different types of engineers and software developers. And so algorithms are typically a great evidence that there's R&D going on. Any type of AI or machine learning, those are kind of next generation forms of algorithms and computers doing a little learning and thinking on their own. And then also internal software development, we just covered that. Cloud development, that's a big one too. That ties into DigitalOcean and Hatch, and a lot of times you're making software that exists in the cloud and you're developing on the cloud, and so you need a solution to support that. And so obviously DigitalOcean has a pretty good space in there. Augmented reality and virtual reality, these are just good overarching things that are inherent in R&D for software when thinking about R&D. This is not all of them. This is just kind of to give you some ideas of things that might qualify within software. So what can be claimed? Qualifying costs. This is the big thing that everyone might ask, like, okay, here's all these activities, but how do I factor this in? The biggest bucket for when you're calculating what your credit can be, what the dollar value of the credit is, are salaries. And those are salaries of people that are directly involved. This might be a software engineer or software developer. Then there's people that are directly supporting those directly involved. And then there's also directly supervising. So an example for that might be you have a team of software engineers that has a project manager or a scrum master who they're reporting to and are help steering the project in a direction. And then even C-suite people or other directors that are in that space, they are playing a role that helps guide that R&D, that product, to come to life and reach the goal. And so all those people's salaries can be factored in, different percentages, obviously, when it comes to the calculation, but that's a big bucket. And if you think about the investment that a software company or any company makes, one of the biggest investments is going to be their talent. And so that's a huge category. Now, building on that, you're also going to have subcontracted costs and 1099 employees. So anytime you're paying people outside the company to do something that's R&D related, those can be factored in. However, it's where salaries you can consider 100% of someone's salary. For subcontracted costs and 1099 people, you can look at up to 65% of their salary. And from those percentages are where you whittle down how much time are they spending in R&D activities. Raw materials and supplies, they're not as applicable as much to software. However, with the birth of IoT and all these internet connected devices, a lot of times, we could be having software people looking at this presentation today, but they might be, writing code or writing an app that actually talks to a few different hardware devices. And so raw materials, things that are used for prototyping and developing that hardware, can be factored in. As it relates to DigitalOcean, computers and cloud computing, it's a huge cost, different annual costs that go into cloud infrastructure and building your application or your web browser or whatever software tool you're building. It has to be supported by a cloud and can be performing different types of analytics. Those costs can be factored in as well. Legal fees associated with filing patents, that's another thing that can be included. And these are the big categories that we're going to be looking at. So, show me the money. How does this all flow through, and how does it work from a tax perspective? If you're paying income tax or payroll tax, you can benefit, and here's how. First, there's the payroll tax credit, and this was something that was a part of the R&D tax credit when it was made permanent in 2015. They also opened the doors to the payroll tax credit. Historically, only Fortune 500 companies would take advantage of the R&D tax credit, and the doors were open for payroll tax credit for a lot of startups on the federal level. And so every employee that's a W-2 employee, that company is paying payroll tax on that employee, probably about in between 6 and 7%. And so you multiply that between a lot of employees, and that's actually a pretty big expense every year for the company. And this is really helpful for companies that are not profitable yet, right? If you're spending more than you're earning, you don't really have any income tax liability. However, you do have payroll tax liability. And this is how you can use the R&D credit. If you have $100,000 of R&D credit and your payroll taxes every year are $75,000, this is a dollar for dollar reduction. So now you'll zero out that payroll tax credit and you'll have $25,000 left over to use and carry forward. And then for traditional companies or companies that are already profitable and have tax liabilities, they can use this R&D credit to offset and reduce their federal and state tax liabilities. And so this is really more traditionally how companies see that. And depending on the startup, some startups are profitable from day one because they might be lean and their platform takes off and they're profitable from day one. Others are kind of working towards that path to profitability. And so this is how you distribute the funds. And there's a couple different ways that we can do that. But I want to dig into a little bit of how, what qualifies a startup for payroll credits. And this is really what the IRS has set forth. Basically, if you're a startup and you want to use your R&D credits towards payroll taxes, because if you're not profitable, then you have these credits, but you can't use them. So the first thing is that within the previous year of business, you have to have generated 5 million or less in gross receipts, basically earnings. You also have to be founded within the last 5 years or within the time the company first reported earnings. And then finally, the relief that you can feel, the maximum credit that you can use is $250,000 per year. Whereas if you're offsetting income tax or payroll tax liabilities, not payroll, but regular income tax liabilities, that is uncapped. And so payroll is capped at $250,000 per year. I will note that there is ongoing legislation, though, to increase that $5 million gross receipt threshold to $10 million, and also to increase the maximum credit to $500,000. And so that's something we keep a close watch on, and that's exciting because startups these days they're a lot bigger, and depending on the investments being made, whether different seed rounds of funding. I'm sure you've seen a lot of different rounds of funding where, some of these numbers getting thrown out are really large numbers. And so I think that's creating a need to redefine, what a startup can be these days. And so I think has a lot to do with this ongoing legislation to kind of widen the definition of what a startup is, and to make sure that if they're not profitable, that they can still feel the relief through payroll. So you might ask, I have all this stuff. Yes, I qualify. This sounds great. Well, how do I go about doing this? What Layton is really an R&D credit firm, and so we specialize in the R&D credit, and we have a process. This is a process that we recommend that a company goes through, and basically we open things up by making sure that there are activities within their business and getting a couple due diligence questions out of the way, and then we also start off with an initial assessment after we feel like it makes business sense to move forward and dig a little deeper. And this is more of a high-level conversation. Layton teams you up with a financial expert and a technical expert. And so we have a lot of different technical experts, whether it's software engineers or structural engineers or scientists, that we would team up with a company to have a little more in-depth conversation about different projects and the products of the business. And after that, we really start an engagement process where we're extracting information, we're having some scoping calls with certain technical people to really understand different projects and really draw some analysis and qualifications of certain activities. And ultimately what you need to do when you claim the credit is you need to have a technical study, a technical report. And that's essentially what we deliver. Is we tie all the technical activities and analysis on that, and we tie those to the financials of the company. And we use different types of calculations to really make sure that you have a maximum and accurate credit to claim. And that after that, you would have a report and you'd have sample tax forms to then, file with your CPA. And that's really how it would work. We would then continue to review that study and want to make sure that you can maximize that credit every year. The time of delivery for these usually takes a month. However, we work with all different types of timelines, whether it needs to be sped up or slowed down. And that's really kind of what a study process would look like. But it's very important that you have this technical documentation to back up your claim should it ever be questioned. So you should claim the credit each year moving forward. There's some best practices that we find to ensure that you're kind of utilizing the credit. We think that you should build this credit into your financial plans each year. This ability to offset the taxes that you owe frees up cash to then hire new employees, reinvest. Some other ideas would be tracking relevant financial and R&D information for real time. So we would want to help you deploy different tracking methodologies, and we'd also help supporting this technical document, author and provide this technical documentation, as you as you work on this every year. And so these are just different ways that you can ensure long-term benefits. And that's really it. The one thing I'll back up before we start with questions, though, is I want to go back to just understanding this slide, because basically, if you're profitable and you haven't claimed this tax before, you can be refunded for overpaid taxes. And so this is exciting for companies that have already paid taxes and they're profitable and they haven't been claiming R&D. You can still do payroll, though, if you fall within these windows and this criteria that you have to meet. So I just wanted to point that out. There's a few ways that this can flow through for different entities, whether you're a S Corp, an LLC, or a C Corp. All those types of entities qualify. And so that's really what it boils down to. That's kind of a high-level overview of the credit, what defines the credit, and what types of activities and how it flows through. And so I'm happy to recap any of those slides and take a deeper dive and field some questions for everyone. But hopefully that helps. And Tim, if you have anything to add, or if anyone's in the queue asking some stuff, fire away. I want to make sure everyone gets the most value out of this. And so if I glazed over something that you want me to focus on more, please let me know.
Yeah, and I'll just jump in and remind everyone to feel free to ask questions, or as Brandon said, if there's something that you want to go deeper on, please let us know. So, Brandon, if you're thinking this is potentially a good idea, you sort of fall into one of those buckets that could qualify for these, but you're maybe a little unsure on where to get started. Do you mind just kind of going over again the documents that you would need to sort of start gathering together as you were sort of beginning the journey to start looking into these tax credits?
Sure, yeah. So the documents that you would want to have together are a list of your W-2s, historical taxes, and P&L statements. Those are the biggest three categories. And if you were to kind of work with a firm like Layton, that would be something that we would request. There are certain historical tax years, even though that we won't be claiming on those years, we have to establish a base credit. And so we have to look at historical financials to understand kind of what can we base the credit on for previous financial statements and income and different spending in different categories. So those are the three categories, really. A list of W-2s, a list of some of your P&Ls from previous years, and some historical tax documents. Another thing would be if you have contracted out any services, it would be those 1099s, and also the statement of work or the contract that you had as an agreement between a firm that might have developed some software for you or helped further along the development of your product. And what we want to explore in some of those contractual agreements or 1099 work is the easiest way to think about it is who's ever bearing the financial risk of a project going longer is typically who owns the R&D. So for example, if you're a company and you are paying a firm to help you with the product development, whether it's design, software, if you're paying time and materials, meaning if it takes a week longer to get the job done and you have to pay for that extra week, that typically means that you are owning the R&D, that you're responsible should any challenges arise. However, if it's a flat fee and the person that you contracted to do the work or company, really they're at risk, because if it takes them longer, they only get their flat fee. They're the ones that are actually owning the R&D. And so we would some of these contracts are two-sided, and one of the complementary services that we have, to start the journey before we would dig a little deeper is do some contractual analysis and really understand kind of the agreements and statement of work between a contractor and the main company, so that we can advise you on what you should be taking advantage of.
Okay, great. I want to dig into that a little bit more, but we have some questions. So first, there was a question about the presentation, and we'll be linking to Brandon's presentation in the YouTube description afterwards. So you'll absolutely get a copy of this, because I know there's a lot of great content. And then Brandon, this question just came in. So do R&D credits apply to companies with foreign founders?
Absolutely. That's a great question. So the R&D credit is for the presentation that we're doing right now. This is for the U.S. And all that matters is that the entity exists in the U.S. and that the employees exist in the U.S. And so all that matters is that that's where the entity is established and that they're employing people within the United States. Some companies will outsource some of the development all over the world, and we can't capture 1099 work that's being paid directly. However, if you're paying through a third-party entity, that's something worth looking at, whether it's like an Upwork. That's the biggest thing is as long as you're spending money within the U.S. to support your R&D efforts, that's what we would want to look at. So it really doesn't matter on the individual level. It really matters on the company, that they are a U.S. company and that they are funding R&D within the U.S.
Cool. Okay, great. So then this question came in from Mark. What are some pitfalls to be aware of in case you're denied the credit or something goes wrong? I guess maybe is there any risk associated with this?
The risk is pretty minimal. Ever since they made the R&D credit permanent, it doesn't flag, it doesn't put any company at extra risk of being audited than they were originally. Some numbers get thrown around. You know, the risk of audit is always there. It's pretty low. I think it's around 3%. It happens from time to time, but it does not happen a lot. You're always going to be a little more at risk when you amend returns. However, this is a credit that they want you to take advantage of. If you think about it in the long run, if you're receiving all this R&D credit and you're offsetting taxes owed and you're growing your business and you're hiring more people, your company is going to grow and you're going to get a bigger R&D tax credit, but you're also eventually going to pay more taxes because you're a bigger company. And so in the long run, it works out for everyone because now your company has grown, you've supported the economy, and the government's getting some more taxes because now they've helped you grow as a company. And so that's really the idea in the long run. If you were ever to get audited, a safety net that we like to put in, at least at Layton, I might vary from other different companies, but we offer 16 hours of audit defense. We've never had to use that much. Our reports that we author are typically formatted in a way to satisfy any initial inquiry when it's questioning the R&D. And that document, that study that you should have, that you need to have, that's what backs up the number you're claiming, right? Anyone can write a number on a sheet of paper, but if it ever gets questioned, you have to be able to back it up with technical analysis. And that's really something that is super helpful when you have a third-party firm do that, because that can really eat into the company's time and their core business. And so that's why we exist, and then that's why it helps. So just again, for audits, it doesn't claiming R&D does not increase the risk at all. The risk is low, and if it should ever happen, we're there to back you up. And we really don't. We haven't to date seen in the U.S. any claims get denied. And if they do get audited, we will back you up. We have, tax attorneys in-house that have litigated and won in court before. And so they have a lot of experience. And that's why we do our due diligence for these studies. We want to make sure that what we're claiming is real and it's qualified, so that if we ever are asked to back it up, then that report is the first line of defense. And should we need anything more, then we have those 16 hours baked in.
Yeah. So, and I think an undercurrent there is working with an expert can certainly help, especially if you're feeling somewhat uncomfortable. So a plug for Layton and sort of your expertise and that extra layer of protection. So we got a bunch of questions, so we'll just keep going through them one by one. So this is another question from Mark. So I think, what are some creative claims? I doubt you can name any businesses by name, but are there, I think maybe the gist of this question might be sort of examples of maybe companies or industries that applied for this that maybe it wasn't noticeable or transparent in the beginning that they would have qualified, but then they did qualify for these tax credits. Anything you can speak to regarding this question?
Yeah, I'll cover this in twofold. One, I think I'll just talk about some industries that might be unassuming, and then another is I'll just talk about how to properly claim and things that typically go overlooked that you don't want to overlook. And that's how you can get a little more creative. For industries, software is a given. However, we see things like construction or any type of food science or even specialty dentists and certain other industries that you might not think R&D, but then when you look under the hood, you realize that they actually have financed some types of R&D. And the biggest factor is just whether they employ technical people, whether it's internally or have they contracted the work out. And that's the biggest thing to think about. Have you developed a product or service that required technical knowledge? And do you employ those people, or have you contracted that work out? And did you take the bulk of the risk when you finance that? And so there's a lot of different unassuming industries out there. And I think more and more every day can qualify because just of the onset of technology, seeping its way into even, whether it's just a consulting firm or a recruiting firm that maybe developed their own app or something, using technology somehow to make their service more appealing or easier to use to a customer. When it comes to getting creative, when you claim, some companies will overlook things. We find that, and this applies directly to DigitalOcean and Hatch people, or people that are interested in taking a dive there, is some people overlook the cloud computing expense, and that can be a substantial one. I've talked to a lot of people where they've already claimed, and we help optimize claims all the time. We typically find that we're able to identify some more qualified expenses. And one of the things that goes overlooked is cloud computing. And so that's a way you can stay creative there. Another way to stay creative when claiming is to really include all qualifying salaries. Some companies will just use salaries of all their engineers, and that's it. Well, what about the CTO? I mean, without his guidance, how are you going to see these projects through to fruition? And so you need to be thinking about those supporting staff, managerial, all the way up, and how many people need to weigh in on that process of developing a product or service where that input is needed to reach the goal. And so that's another thing. And then a third thing I'll say is the way you're structuring your contracts when you do 1099 work. You can leverage the structure of those contracts so that you actually are taking a financial risk, and that you are paying more time and materials maybe than you typically have had those contracts structured. And so in that way, you're able to factor in more of your outsourced work as it relates to R&D, and that way, recouping more of those expenses. The whole idea is that you're spending all this money to develop something that's innovative. You want to get as much of it back as you can, and this is the credit to do it. It's one of the most lucrative ones, and like I said before, it's a dollar for dollar reduction in payroll or income tax.
That's awesome, Brandon. Thank you. I think that for me, that was very helpful. I hope that was helpful for the person who asked the question as well. We got a bunch more questions, so we'll just keep going through them. So this question came in from Dennis.
Okay, so I have, if the development is made by independent contractors outside of the US, but the IP owned by the US company, are the credits applicable in that case? Interesting. So this is an interesting one. I think first and foremost, if you're financing R&D outside of the US, again, if you're paying a third-party entity within the US, we can look at it. If you're wiring money straight overseas, typically that kind of squashes any expenses related to that. However, if you do own the IP and you filed for a patent, or you have attorney fees that you've paid for in the US, that applies to the credit. And so you would want to look at those expenses. And so those are things that you would want to look at. Those two things. Did you pay a third-party entity? Did you pay through a third-party entity in the US? And what expenses went into that IP as far as legal fees and patents and stuff like that? So hopefully that answers the question a little bit.
Yeah, I think the key there is more context is needed before you can give a definite answer for that kind of question. Okay. This question just came in as well, and if you asked a question, we're going through them one at a time, so don't worry, we will get to yours as well. If there's no payroll, just borrowing or savings from one's own time and IoT hardware and other services in cloud. I think you've addressed this, right? Like cloud costs are sort of fall under that creative. It just sort of depends on how they're being used, but what do you think for this particular person and their what they're spending their time and money on?
So it's an interesting question. Obviously, a lot of software or any startups are bootstrapped, and some of them don't even have payroll. And so the question I can see, I'm reading between the lines, if there's no payroll, how do you feel the relief? If you don't have any payroll and you're not profitable, that means you don't have payroll tax and you don't have any income tax. In that case, you can still claim, you just can't feel the relief. And so I'm sorry if I overlooked this before. Basically, any company can claim and you can have this credit. It stands, if you can't use the credit, it stands on your books for up to 20 years. So a lot of companies will use this as a strategy, and they'll start claiming the credit a couple of years before profitability, so that the second they turn a profit, they can wipe out any income tax for the first few years in business. And so this is a unique strategy where they'll bank the credits so that when they do become profitable, now they have this huge pool to pull from, and they might not have to pay any corporate taxes for a while if they build that credit up. The other nice thing is that the credit acts as an asset, and so it increases a company's valuation. So if you are a startup and you have an exit strategy, and maybe you're in the business, maybe you're an entrepreneur and you have all these different startups and you want to grow them to a certain size and then sell them to the highest bidder or something, it's important to try to leverage these R&D credits. Even if they can't be applied to the business, they still act as an asset. So you can probably get a higher ticket value, a higher price value on that company when you're trying to sell it if you have R&D credits that are going to carry over through the sale. And so it's a great question, though, because there is kind of a purgatory area that companies can live in where they don't qualify for payroll and they're not profitable. So it doesn't mean they can't claim. It just means they have no way to feel the relief right away. There are some states, Pennsylvania is one of them. I can find a list for you after this presentation. There are some states that will allow you to sell the credits, and there's some type of marketplace. That's interesting, right? Because you could claim the credits. You might not be able to use them, but you can sell them, and that way you could get cash for them. And so there's a lot of different ways to get creative with them, and hopefully I just outlined a few.
Awesome. And this one's going to be tricky for you, Brendan, I think. So you've mentioned before, this is strictly a U.S. Tax credit. Do you happen to know if there's anything available in Canada that is similar to this? Putting you on the spot.
Yeah, that's okay. We actually have a location in Montreal, I believe. Layton exists, like you said, in 11 countries. Those are big countries that offer really good R&D incentives. The governments have made a permanent commitment to incentivizing companies that innovate, and there's more countries that are participating in it as well. Canada is one of them. So yes, you can take advantage of an R&D tax credit in Canada. I don't know, however, if you can leverage payroll tax. That's something that I would have to look into. I can find it out, right after this, and address that, or they can reach out directly to me. My email is bcarroll, BCARROLL @layton.com. I can cover that again at the end, but I know that there is an R&D tax credit in Canada. I just don't know if payroll applies.
Yeah, and we'll post Brendan's email here as well, just in case you want to follow up. So what if someone wanted to start working, Brendan, with you or with Layton, what's that process look like?
So that process would be, everyone that registered is going to get a thank you email. They can go through that. There'll be some information on how to reach out there. They can, like I said, contact me directly. You can look me up on LinkedIn, message me, or email me at bcarroll@layton.com. But but those will be all the different channels to go through reaching out. And the process is pretty similar as I spoke about a little earlier. This is the process that we would go through. So we're just going to have a conversation. Let's learn about your business. We'll tell you about our process, and let's just kind of explore what you have going on that might qualify. If that makes sense, and we agree that there's definitely some traction here, and this is something that you should pursue, then we usually recommend an initial assessment. And that initial assessment pairs you up with a tax expert and a technical expert. And that's when we take a little bit deeper dive and we make sure that there actually is something worth pursuing. It's going to be mutually beneficial for both parties to pursue. And that's really, we'll start the engagement process, and we'll start working on the report. Our business model is a percentage fee that is based on the net credit we identify for a company. So that's not really dealt with until we deliver the report. We want to make sure we do all the work up front and make sure that the company has what they need to claim before we apply a fee or anything like that. So that's really the process. Go through any of those channels of communication, whether it's replying through a piece of Hatch communication or DigitalOcean or a thank you from Leighton, or just hitting me up directly. Brandon, Carroll, you can find me on LinkedIn. And like I said, you can reach out through email or any of those channels, and I'm happy to walk you through. It really just is a matter of setting up an initial conversation. And if we think that it has legs, then let's have an initial assessment to make sure that it makes sense to pursue the credit.
Yeah, so I think that answers really well this idea of like risk and is this for me? I think for probably a lot of folks, this can be somewhat overwhelming. As soon as you get into not complicated, but for me, complicated tax policy. But the fact that you can reach out, talk to someone, get an initial assessment, get your or one of your team members' expertise, I think for the community at large, that should make you feel a little bit easier about at least exploring this and thinking about it. As you said, even if it's not the right time, maybe if you're bootstrapped and you don't have a payroll, it's still worth maybe exploring right now and preparing, getting those credits to use at a later time, or at least starting to think about, well, what if I have employees next year? It's not like this credit is going away. So that's great. And also,
yeah, exactly.
Go for it. Sorry.
No, I was going to say, yeah, it is permanent. It's not going away. And the other thing that I'll just build on that for a second is there's no obligation. There's no harm done in checking and kicking the tires and talking with a couple experts to see if this is something that's worth taking a look at. And we're happy to do that. And let's say we do enter a working relationship, and we help you author a study. We're still there the other 300 days of the calendar year to advise you on R&D investments and things like that. We're a large group, and we want to make sure that we're seen as a true value-added partner outside of the R&D study. Awesome.
And I shared, you have a form on your website, R&D Tax Credits for getting you through COVID-19. So I shared that. So if you're curious about having a conversation with Brendan, in addition to sharing his email, I shared that form. So questions about this process, questions about fees, all that stuff, I think that would be the appropriate sort of next step, is just fill out a form and have a conversation with you, Brendan. I think that sounds fair, right?
Yep.
Okay.
Yeah.
Well, this has been awesome. I think at DigitalOcean, we spend so much time trying to learn sort of what startups and founders and small businesses are building from a technical capacity. I think it's important for us to remember that there's all these many other facets to running a business outside of just the amazing technology that you're building. And I think this is a really important piece in general for running a startup or a small business, but also especially in times like these where it's just frankly tough for a lot of businesses out there. So we really appreciate you spending some time giving back to the community, and hopefully this was helpful for the folks listening in. Again, we shared some different ways to get in contact with Brendan. We'll put that in the YouTube description as well, so that you feel confident in terms of looking at these slides or contacting Brendan at a later point. If you registered for this webinar, we'll also be following up with an email with the exact same information. And we'll also make sure this goes out in our newsletters. I saw some questions throughout about DigitalOcean's Hatch program. If you're a startup or work with startups and you're part of the DigitalOcean ecosystem or thinking about it, check out DigitalOcean and check out the Hatch program. We shared a link in the comment. I'll share it again right now. But that explains the program and how we typically work with startups here at DigitalOcean. This webinar is part of that program. It's part of our commitment to giving back to the community and trying to encourage learning wherever it can be found. So if you're curious, we'll share that link again, but you can visit that site. So Brandon, thank you so much. This was obviously incredible. So much information. I think I saw some thank yous going out. Anything else before we wrap up that you want to mention?
No, I appreciate everyone hopping on this. Obviously, we're all at home right now and we're doing everything we can. And I think financial relief, financial relief is at the top of a lot of companies' minds. If you're doing any type of investments like these, I would use this as a tool to feel any type of relief. I mean, for payroll specifically, you can feel it quarterly, and that goes through your payroll provider. We've helped a lot of different businesses understand kind of how to work through their payroll provider and feel that. But I appreciate everyone's time and for chiming in. And if it makes sense, we'll do another one with a different focus. And I'm happy for people's questions. And I hope this was informative and can be helpful.
Cool. Thank you so much, Brandon. And yeah, we'll wrap up by just saying, as we say at the end of all of these around this time, is we hope you're staying safe wherever you are and healthy. And again, feel free to check back to the DigitalOcean YouTube page later. We'll have all the links in the description, and you'll be able to watch a recording of this video. I think for something that had as much education as Brandon's presentation did, it'll be great to re-listen to this. Also check out the slide deck as well. Hopefully that's helpful. So thanks again, Brandon, and thanks everyone for tuning in. We'll see you all next time.
Thanks, Tim. I'll talk to you soon.